we do know that if we go the route of traditional asset classes, I'm not so certain that families are going to be smiling to their banks and looking favorably into their accounts. So what would you say within the space of the PE, the private equity and the venture capital space?
Yeah, I mean, I think Messi, you know quite well that I'm someone who's very bullish on the future of VC and private equity. The market always goes through cyclical periods where we have a couple of years of growth and then a couple of years of pullback. But that's largely driven by large institutional players. But family offices, in contrast, they sit in a very interesting position where they have the opportunity to get the best of both worlds, to thrive both when global economic markets are turning down and VC markets struggle to raise capital, and to do well when VC markets are booming. I think from my point of view, 2023 is really going to be shaped by movement of capital and movement of individuals. This really affects the private equity space as well, because for any fund, whether a VC fund, growth fund, or private equity fund, the relationship that they have with their backers, with limited partners, is shaped by what's currently going on in the market. Right now, for example, in January, you don't want to be an emerging manager raising your fund for the first time, because you're in a scenario where you're competing with a record number of new managers, emerging managers, first-time managers, and at the same time, the global economic outlook, as so well mentioned by Rashid, Tsitsi, and Troy earlier, is not necessarily looking very optimistic. At the same time, I think specifically for a family office that has the relative luxury of being able to control its own microeconomic environment, the private equity market, especially the long-term illiquid nature of private equity markets, actually acts as an amazing hedge against market volatility today. What you see happening in public markets, where an ETF portfolio can be destroyed overnight, or where a public equity portfolio is essentially entirely exposed to geopolitical risks, that takes time to trickle down to private markets. And the core fundamental advantage that private companies have is that almost lack of transparency, which means that they have a shield protecting them from public opinion. The price of a company is valued less on what the public thinks, on what Elon Musk posts on Twitter, or on what the current trend is in social media conversations, and much more on the fundamentals of that company and the potential they have ahead of them. With that in mind, if family offices increase their exposure to private equity and VC now, once the economic recession that we are most likely to see in the next year is finally over, whether that's in 2024, 2025, or even 2026, they will be at an advantage to any other institutional wealth manager that maybe has currently been decreasing or not increasing their exposure to this high risk, high reward asset class. So yes, I think I stand by my typical position. I would strongly advise most family offices to diversify into the alternatives, with a view that long term, this will help them ride out the current crisis and come out with a strong advantage in generating new family wealth.